If we take a look at gold and silver, both of them are up about 1% this morning. They were up fairly sharply earlier this morning, but they're starting to pull back. We can see gold pushing up, hitting 42, 40, somewhere up in that range. Definitely a strong move. If we take a look over at silver, it continues to melt up. It hasn't broken its high from yesterday, but it continues to hold up. Again, lots of volume in this space. When we look at the volume, it is ramping up and everyone's piling into silver. Again, when you get big moves and massive volume, it is usually a warning sign. Doesn't mean the trend is over. It just means the risk is increasing and bubbles get closer. They get thinner and thinner, closer to popping at any point. And just being aware of that is important because the market doesn't go up forever and there's been big gains, and at some point the market will have to have some type of reset, a bout of selling that could last several weeks, months, who knows, or even years in some cases, in many cases. Taking a look at the charts, equities are set to open higher this morning with the majority of money flowing into small caps. We look at the Russell 2000, it is pushing up to some new highs here. And we're seeing small caps really get a boost. Tariffs, I think, are going to hurt the big multinational, huge companies, and small caps and kind of squeeze through the cracks. I think we're seeing definitely not only that, but we're seeing speculative money pile into this market still. And of course, speculative money doesn't so much want to get into the big blue chips. They want to get into the small, faster moving stocks. So we're seeing kind of this double push to the upside with small caps. Now, if we go and we look at the rest of the indices like the S&P 500, the S&P 500 is up 0.75%, so having a continued push up after this big crack to the downside. We do have, if we look at the SPY, we do have the SPY and the NASDAQ. When we look at the bottom chart here, we had the majority of volume kind of trading right through this range. You can see we're kind of in this resistance zone. Now the market has gapped above this, and this is what the market loves to do. The market closed down at the lower end of the range. It is set to gap above this level, and gaps to the upside tend to get sold into. And on top of that, if we were to look at the SPY chart,
while the S&P 500 is climbing around 0.75%, it's approaching a critical resistance zone. After recent sharp declines, the market has gapped higher, a classic setup that often leads to short-term selling. Technical charts for SPY and QQQ show price spikes to the downside, suggesting a likely retracement to fill those gaps. Yesterday's exhaustion gap down reversed quickly, and today's scenario is its mirror image, a gap up near resistance that could face selling pressure. Traders are cautious as recent sessions have featured whipsaw action, large gaps, intraday reversals, and rapid swings that make short-term forecasting increasingly unpredictable.
Just zoom in, you can see there's actually a price spike to the downside, showing that price this morning today should move down and fill that spike. It's also the same with the QQQ. We had the same really over the last couple of sessions. Yesterday, we saw a spike to the upside. The market ran up and actually hit both of those spikes. Today, we have a gap higher and we've got spikes to the downside. So pretty much it's just the flip of yesterday. Yesterday was a huge exhaustion gap, short-term exhaustion gap to the downside. It flushed down and then came up, filled the gap, and also filled the spikes. Today, the market is going to gap up slightly higher, just above resistance here, and could very easily sell off for a short-term pullback in the markets. Now, if we take a look at the QQQ, you can see just based on this low here where it started, had a consolidation and really started to run up, it's up about 3.3%. Now, we've touched on the utilities for a while. Utilities for the exact same time frame are up 11.4%. We have this big divergence. We started to see this take place slow and steady. It keeps getting bigger and bigger. And now, well, it's at that point where we mentioned it earlier last week, that it's at the point here where at any point the market is going to have a big red bar. It's going to have some shock to the system. And that's exactly what we've seen. It's still holding up. We're seeing utilities move higher while the stock market struggles and trades sideways. That's still a warning sign we need to be aware of. Of course, the stock market in general, when we just look at QQQ or the S&P 500,
a notable divergence is forming between equities and utilities. Over the same period where QQQ climbed roughly 3.3%, utilities surged over 11%. This defensive outperformance is often a warning sign. As growth stocks trade sideways and volatility remains elevated, investors are quietly shifting into stable dividend-paying sectors. Momentum indicators show markets oscillating between overbought and oversold conditions, with fear and FOMO rapidly alternating. Such choppy conditions are historically dangerous. Gains can evaporate overnight. Technical signals suggest the market is transitioning from an uptrend to a neutral phase, often a precursor to a larger downtrend if momentum fails to recover.
Is really just flip-flopping around between overbought, oversold territories with our FOMO indicator where the market pulls back. We had FOMO over here where the market really actually it did have its quick little pullback, but more continued to struggle. We went into an oversold condition right here, a panic selling. It popped back up, and then we had a little bit of panic selling right through this day over here. Sorry, not panic selling. We had panic selling right over here. And the market is really chattering. Lots of volatility, huge sell-offs, big gaps, pops and drops. This is dangerous stuff. It really is just a coin toss every day. Are you going to make money or lose money if you're playing this? And so the momentum here on the market is stalling out. It's changing direction. And we don't really want to be in this market anymore because it's not safe. It's random. It's got big price action, and we don't need to risk our capital. If the market does want to start to run higher, it'll generate a new trigger and things need to solidify. They need to get stronger here. But right now the market is definitely losing momentum. And if we look at the SPY, you can see, or the SPY, we've got orange bars showing us that the trend is going from an uptrend to now the momentum is shifting to neutral. Usually after neutral, the market changes to a downtrend after it works itself out. Now the market might still want to push and grind its way up before potentially going for a swan dive, but overall the market momentum is definitely stalling out. Now if we take a look over at precious metals and the dollar, we do have the dollar down just a little bit today. Again, it's building what looks to be potentially a bull flag where this could pop and have a big move. If this does pop and rally, it probably means the stock market is going to be heading lower. And so it's kind of an inverse play to the stock market.
Gold and silver opened strong, each climbing about 1% before pulling back slightly. Silver continues its steady melt-up, supported by surging trading volumes. Gold, now testing the 2040-2250 range, shows parabolic behavior reminiscent of pre-2008 market patterns. Large inflows into metals often indicate growing risk aversion and crowding, a sign that trends may be overheating. While rallies in this sector can be explosive, they're often followed by abrupt corrections. Historically, such phases end with sharp resets, wiping out latecomers who chase the final leg higher. Investors are advised to lock in gains strategically rather than attempt to capture every last dollar.
If we take a look at gold and silver, both of them are up about 1% this morning. They were up fairly sharply earlier this morning, but they're starting to pull back. We can see gold pushing up, hitting 42.40, somewhere up in that range. Definitely a strong move. If we take a look over at silver, it continues to melt up. It hasn't broken its high from yesterday, but it continues to hold up. Again, lots of volume in this space. When we look at the volume, it is ramping up and everyone's piling into silver. Again, when you get big moves and massive volume, it is usually a warning sign. Doesn't mean the trend is over. It just means the risk is increasing and bubbles get closer. They get thinner and thinner, closer to popping at any point. And just being aware of that is important because the market doesn't go up forever and there's been big gains, and at some point the market will have to have some type of reset, a bout of selling that could last several weeks, months, who knows, or even years in some cases, in many cases. If we take a look over at crude oil, actually we'll look at crude oil. Crude oil is trying to stabilize. It did come all the way down to that $57 per barrel range. We've been talking about this for months. It was the next kind of pivot low. The big question will be, once it gets down to this level and starts bouncing bottom a little bit more through here, if it breaks that, then we're probably headed down to about $45 per barrel. So again, the oil is just slowly working its way down the chart. If we take a look over at Bitcoin, down another 0.8% this morning, just refusing to find a bid, just kind of bleeding out here, fizzling out.
Crude oil is hovering near 57 per barrel, a key support zone. If it breaks lower, analysts expect a potential slide toward $45. Global supply dynamics and weakening industrial demand are applying steady downward pressure. Bitcoin, meanwhile, is slipping another 0.8%, extending its slow bleed after months of lackluster momentum. Following its 2024 post-halving rally, enthusiasm has cooled as liquidity tightens and regulatory uncertainty lingers. Many traders have exited, awaiting clearer signals. Both assets highlight a broader market theme. Capital is becoming more selective and defensive, seeking stability rather than chasing speculative, high-risk opportunities.
Again, not a big fan of Bitcoin. We closed out our Bitcoin trade, I think it was over here or over here, and we've just been letting it kind of digest since then. Not really looking to get into it. And of course, our gold trade, we did have a discretionary gold trade. We hit our target for that. Our short-term trade for gold, we are out. We got in here, we got out right here. That was a nice quick 15%, very low risk. It just pretty much almost went up every day since we bought it. Now it is kind of in, you can see volume ramping up in the futures. It's starting to really go parabolic and become that crowded play. And it's not about making every single dollar of a move. It's about playing it safely, pulling money out, and living another day. There's always going to be another opportunity to get in. I don't worry if something runs and goes higher without me. While it does suck and I don't like the feeling, it's just part of the game. If you think you're going to catch an entire move, it's never going to happen unless it's a fluke and you pick a top and it just happens to be the top. But overall, the market will need to have a sharp pullback and correction before even a downtrend starts. So no matter what, even if you follow technicals and you're doing a trend following strategy on here, then you're going to have to give back a bunch of it anyway before the trend reverses and gives you that sign. So I know a lot of people are just stuck in here. They don't want to get out. They think it's going higher. That comes down to your personality and your trade. The trade that we put on here was nothing more than a technical trade. We get in, we hit partial profits, we hit 100% target, we get out. We still hold gold, or I still hold gold. Long-term investing, I still think gold could still potentially pop and move higher. But we're in this last final phase where I think it's really shooting up. And again, it's some of the biggest percentage moves happen right at the end of a trend. And if we take a look at it, let's just go to the monthly chart. You can see it's going pretty parabolic here. And we just go back in time. You can see, this is typically what happens. Gold starts to really take off. We go back over here. This is what it did just before the 2008 crash. It ran up, put in a big pause, it had the second half of that move. And then, right when there's huge volume and everybody thinks it is the play is generally over.
The VIX recently spiked, signaling a surge in fear, but the put-call ratio remains surprisingly low. Traders continue to bet on dips being bought, revealing complacency beneath the surface. This sentiment mismatch often precedes sharp market corrections. Defensive rotations, rising utilities, and strength in gold all point to growing caution. As 2025 unfolds, geopolitical tensions, shifting monetary policy, and slowing growth are reshaping capital flows. The smart move in chaotic markets isn't to gamble, it's to protect capital and wait for clear, sustained signals. When the reset comes, new opportunities will emerge, but only for those who preserve their resources.
And I say generally over, it did pull back 34%. It took a year and some time off before then going even higher. So again, this is just kind of where we are right now. I believe we've had a couple very nice measured moves to the upside. We've had the first one up in a pause, and we hit the second one, and now we've hit the third one. So it is definitely measuring its way up. If we take a look at gold miners, for example, let's take a look at GDX. Again, going parabolic, hitting some all-time highs. Silver miners, if we look at SILJ, same type of thing. What goes straight up with huge volume usually becomes a crowded play. And all the big volume going in generally sparks the emotional traders who chased it in are also going to be the ones fleeing and running for safety when it starts to sell off to a certain point, and it wipes out very quickly. Emotional moves are short-lived. Very big in many cases like this, but they are short-lived, and if you don't know when to step off that plane, it might go for a nosedive. Anyways, if we take a look at the VIX real quick, you can see obviously a big bout of fear hit the market. That's also why we saw a big spike in our panic selling indicator. People running for the door, dumping shares. They got that spook, and then the market's trying to digest what's going on. So if we take a look at the put-call ratio as well, put-call ratio, surprisingly, it's still really low. I'm surprised we didn't see it go higher. In fact, people are very, very bullish. They're still buying calls even after that. That big spike in the selling of the stock market and the spike of the VIX didn't even send this up higher, which is pretty impressive. That's telling us there's a lot of complacency. It means people think every dip is going to get bought. The market's going higher, and it is at this point. But at some point, that train comes to an end. And of course, utilities and sentiment are all starting to tell us that things are shifting, and we need to be aware. It's best to avoid chaos than it is to hold through it. And all the markets are telling us, all the different assets are telling us money has been moving away from equities. It's getting protective and defensive. And that's what we want to focus on, is protecting our capital. And when something resets, we can get back in with a new opportunity.